FSN Radio. It's all about what's next. Go to FinancialSurvivalNetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is March 6th, 2017. Well, gold is down a bit. It's about 3 p.m. Eastern time. Oh, by the way, we start that idiotic ritual again, meaning rolling back the clocks, trying to make up for lost time, which it isn't really lost and we'll never make up for it anyway. That's this weekend on the 12th. So get ready to have your sleep cycles disrupted. But in any event, the gold cycle will down $7 and change the last time I looked, but we'll look again before, because the person you're about to hear from, things like that actually matter to him. And talking about Craig Hemke, aka Turd Ferguson, TFMetalsReport.com. And if you have any questions, comments, etc., send me an email, kl@kerrylutz.com, kl@kerrylutz.com. Craig, welcome back.
Hey, Kerry, good to visit with you again.
As always. So interesting things taking place in the world, throughout the world. I won't even get into the whole Trump thing, but looks like we hit a little intermediate peak in precious metals prices. Little pullback. The stocks basically broke down a couple weeks before the metals did, which is exactly what we've all come to expect.
Yeah, it's all part of what we've been dealing with for years. I call it the paper derivative pricing scheme, where price is discovered not through the trading of actual metal itself. Nobody ever actually says how much we give you, for my physical metal. It's always the paper derivatives that determine the price.
Right. Well, why would you look to the price of the metal to determine what the price of the metal should be? Why would anyone do that?
Exactly. I remember, Kerry, at the conference that you held in Las Vegas a couple years ago, I got up and spoke about how it's basically alchemy. The central bankers of the world, especially here in the U.S., in trying to defend the dollar and gold standard all through the 50s and 60s, were losing physical gold hand over fist. And the U.S. took on that role in the 50s and lost about a third of their stockpile. So we shifted it to an international, group of defenders, what we call the London Gold Pool. That worked for 7 or 8 years in the 1960s, and then it failed. But then the latest thing, which now has been in effect since the middle of the 70s, is this alchemy of paper or synthetic gold, allowing that to set price, because that's almost limitless how much synthetic gold has been created over the last 40 years. But it is the trading of those derivatives, that synthetic gold, that somehow sets price for the real thing. We'll see how much longer that can continue, but that is how it's done.
Yeah, talk about the tail wagging the dog, huh?
Right. Exactly.
Yeah. I'll never really understand what the heck this is all about. It just makes no sense to me whatsoever, but somehow it just keeps moving along.
Yeah, we hope that, the idea has been prevalent, in my mind, on my side, all through the gold community for years, that eventually there's going to be a failure, that you can only lever up the physical ounce of gold so many times, 10 times, 50 times, 100 times. And nobody at this point has any idea how much gold there actually is with, free, clear title to be delivered versus how many outstanding claims there are, be it in London or New York or, these unallocated pooled accounts that are run in Canada and Australia and in Switzerland, places like that. And it's kind of a confidence game. As long as the holders of the synthetic gold actually think it's gold itself and that, I can always go get my gold whenever I want, then the game continues. It's when suddenly there's, wait a second, I got to wait 90 days? You told me I could have it any time. If suddenly 2 or 3 people show up at once demanding the same ounce of gold, that's when the thing begins to unravel. Like I said, we continue to wait for this to happen, but there are signs that things are pretty tight. And there are fundamental changes that have occurred here in the last several years that really impact that demand for the real physical, whether it's negative interest rates, whether it's the pending, it seems, dissolution of the euro currency. There are a number of things that could finally take us past that breaking point of this paper derivative scheme. But until we do get that breaking point, it's the system that we're stuck with.
And stuck with it we are.
Yeah, no question about it. And so we watch, and see how price moves. Again, though, understanding that the only thing that moves price is not so much the supply and the demand of physical metal, it's the supply and the demand for the derivative. And so we've got to have, as prices set in New York and electronic trading most of the day, we've got to have demand for that COMEX derivative. And when there's periods of less demand, price goes down. And when there's period of increased demand for the derivative, wanting that gold exposure, price goes up. And as you mentioned, the last week has seen a drop off in demand just because, gosh, how things have changed in the last week. We've gone from maybe a 30% likelihood of a Fed rate hike next week to suddenly a 99% likelihood of a Fed rate hike next week. And that suddenly has been kind of foisted upon the gold market and all the markets, and they've reacted. And there's not a lot of demand, at least here today, for the gold derivative because, the Fed's going to raise rates next week. But as we turn the corner, and if they do in fact hike rates, then we get to this point, maybe by later this week or early next, where people begin to anticipate where we go from here. Well, maybe this means the Fed's not going to hike rates now for 6 months. Maybe this means maybe rising interest rates are actually been good for gold in the past. All these different things begin to get factored into the equation. And hopefully, as you said, this is just kind of a short-term move in price in what will be a pretty good 2017.
Yeah, that's what I'm expecting here. I mean, I didn't feel that optimistic for the past 4 or 5 years, with the exception of last year, which was a darn good year. Mm-hmm. Up until December, which, right, you expect December's to be bad now because they want the end of the year to look bad vis-a-vis all the other investments, right?
Well, that certainly plays into it. And you seem like at the end of every quarter, you get some rather interesting action as the banks square their books and the trading desks, square their books to make sure their bonus pools are nice and fat. What was there a story just last week at JP Morgan had only lost money like on 2 days of the last 5 years on their proprietary trading desk? I mean, give me a break. Anyway, I think Kerry, there's beginning to be an understanding that is starting to work its way into the gold market, if you want to call it that, because price came down rather dramatically in November of 2015 ahead of that first Fed rate hike in 8 or 9 years. And price bottomed the very next day after that FOMC concluded in December of 2015, and then went from 1050 to 1380 before rolling over and going back down into the end of last year ahead of the second rate hike. And price bottomed and turned and went higher again the very next day after the rate hike, going from 1130 to 1265 last week. And so now we're going down again into what everybody thinks is going to be a rate hike next week. And so maybe we'll turn and head higher again as soon as the rate hike is behind us. At least that's what I'm starting to think is going to happen.
Yeah. I mean, what would happen if they didn't raise rates? Yeah,
that's true too. That's true too. But, Kerry, the other thing, a lot of folks are like me. I mean, I prior to 2007 or 8, I didn't really give gold a whole lot of thought. I was trading commodities and, trading stocks and things like that. But I didn't really give the whole financial and monetary system a whole lot of thought. And then, everything happened in 2008 and it's eye-opening for just about everybody. And in the time since, we saw gold and silver skyrocket in 2010 and through 2011 as interest rates were coming down and the dollar was going down. And we all thought, well, maybe that's the only way gold can go up. Well, what's kind of forgotten in all of this is gold actually bottomed in about 2002. And between 2003 through 2007, that 5-year period, it tripled from about $300 to more than $1,000. And that was a period of what was perceived as being economic growth. Interest rates were flat to higher. The dollar actually was falling a little bit through that period. And that was a period that gold took off and did quite well, obviously. And it was a period of rapidly increasing U.S. national debt. So this idea that just because interest rates are trying to move higher, at least on the short end, is somehow a death knell for gold. This gold is somehow going back to $500. I mean, it just doesn't really fit the historical pattern.
No, not at all. And everyone's trying to relive the 80s there when interest rates went to 20+%. And then you had a real interest rate of 7% or higher. Here, you're not going to have real interest rates going to 7%. I mean, I just don't believe that that's within the realm of possibility. So to think that that the paper returns on paper assets are going to rival what they were in the 80s, I rather doubt it.
Yeah. Well, and Kerry, you mentioned earlier, it's now just assumed that the Fed is going to raise next week. But I would point to the other side of that. I'd point out that we haven't seen any other interest rates really move at all. I mean, they're talking about raising that overnight rate, the Fed funds rate, by 25 basis points. But the last two times that they've done that, which again are the first two times they've done it in the last 10 years, but in the last two times they've done it, we've seen things like 3-month LIBOR move up 25 or 30 basis points before the Fed hiked. Well, LIBOR's barely budged at all ahead of what is allegedly going to happen next week. And in fact, the time since we had the December rate hike, the 2-year note, the 10-year note, and the 30-year long bond are actually showing a lower yield than they were 90 days ago. So it's not as if the whole yield curve is moving up, as you point out. And all we're really seeing is a flattening of the yield curve. And in a traditional economic sense, that's a precursor of recession, which means the Fed may have to turn around and start cutting rates again before too long. So it all kind of gets all back to this idea that this year is going to be a wildly unpredictable year. Geopolitically, politically, economically, we got the elections in France coming up in a couple of months. We got Italy, as people call it, Brexit, all this other stuff. We got North Korea shooting off missiles. We got the South China Sea. I mean, I could go on and on. All of it augurs for a lot of uncertainty, not certainty. And in the end, that augurs well for gold. Yeah.
There certainly is a lot of instability in the world. And, the strong dollar. I mean, what's your feelings on the so-called strong dollar and the way they keep jawboning it? I mean,
yeah. No, you're right. And actually, I posted a chart on my site today showing that the dollar index is about 101.5. Well, that's where it was a couple of weeks ago. That's where it was in early February. That's where it was in middle of January. It's actually where it was in the middle of December. And 101.5 is actually where it was about a week after the election of Trump. Mm-hmm. So we've had a lot of things that have happened now coming up on maybe a second interest rate hike, and the dollar basically hasn't budged at all. I mean, if I were long the dollar, thinking that, king dollar, and then it's going, the index going to 110, you'd have to start getting pretty nervous here with all that's happened and now maybe 2 rate hikes, and yet the dollar hasn't budged. It's like this notion that was put out at the end of last year. I mean, you couldn't go onto an internet site, a financial site, not read about the bond bubble and how the bond bubble was finally going to burst and that interest rates are going to skyrocket under Trump, under all this infrastructure spending and everything else. Yeah. Well, like I just said, that rates have moved down on the long end, not up. The bond market has firmed. It hasn't sold off. And so this idea that if you're a bond bear, if you think interest rates are going higher, I mean, you're continually befuddled by this and continually goes against you. I remember seeing back in January, the net positioning in Treasury bond futures was the most short it had ever been by speculators. Well, if anything should tell you which way rates are going to go, it's the opposite of how those bets are placed. When everybody's on the same side of the boat, market almost always goes the other direction. If anything, because if everybody's already sold, there's nobody left to sell and you're left with nothing but buyers. Yeah. And so I just think that the dollar bulls, the bond bears are going to continue to be confounded and astounded by the degree to which they're wrong as we go through this year.
Agreed. Hey, you want to hear a great story about finding gold in a junkyard? They found the Ford Mustang that was used in the movie Bullet in a Mexican junkyard.
Wow.
Talk about finding gold in a junkyard, huh?
I would say so. Steve McQueen probably rolled over in his grave, right?
Yeah. Hey, man, I almost rolled over in mine. I'll tell you that. Jeez, my future graveyard. Oh, my God. Ugh. Yeah. 50 years since that Mustang was last seen.
Wow.
Yep. One of two. Well, there were actually more than one used in the movie, obviously, because you bust up those cars pretty good, and they modified them. You can read about it. You can watch the chase scene. It's one of the best movie car chase scenes of all time, Hollywood chase scenes. So anyway, not to get too far off the subject, but look, you never know where the gold is going to turn up.
That's right.
Point.
That's right.
It might just turn up in China for all we know. Right?
Good point.
But in all seriousness, something is going to give here. And we're getting to that point where, they're just playing whack-a-mole. And, where's the mole? Where is he going to pop up next here? Right?
Yeah. And to something we did addressed earlier, Kerry, the key will be whether these bullion banks can continue to supply the physical gold into the market. Because again, this paper derivative pricing scheme is basically a confidence game. It's one of, let's call it just-in-time delivery, right? Just like your grocery store.
Yeah.
But anytime there's a blizzard or any threat to that delivery and there's a rush to everybody wanting bread and milk at the same time, the shelves get cleared out. Well, these bullion banks supply physical metal into the market on kind of a just-in-time basis as well. But if there's ever a rush for physical metal, be it, a geopolitical event or, like I said, I mean, if you're a German citizen and you're faced not only with the dissolution of your currency, but negative interest rates if you try to save in said currency, well, why the hell do you want to hold euros? I mean, why wouldn't you own gold? Well, it doesn't pay a dividend. Well, that beats the pants off of a negative 2% dividend, doesn't it?
Yeah.
So if there's ever a rush all at once for gold, it could crack the system just as, you're cracking the bread or milk system anytime there's a blizzard or a hurricane. So that's what we're waiting for. And again, I'm certain that day is coming. And you just never know how the events might play out here in 2017 that might make it sooner rather than later.
Yeah, and I saw it firsthand when we had that threatened hurricane here in Florida, in South Florida. And, there was no gasoline in any of the stations. The shelves of the supermarkets were just literally swept clean. I mean, it was really, Greg, it was amazing. You never saw anything like it. Really
and again, that just-in-time delivery is a confidence game. You don't worry about how much milk or bread or gasoline you have if you know that, well, I can always just go tomorrow. But when there's a hurricane or a blizzard or whatever pending and you think, well, I can't go tomorrow, then everybody goes today and cleans them out. And that's what eventually will happen to gold, silver probably as well. This confidence game of, well, I can always go get my gold if I need it. I can always convert my dollars to gold as the system changes. Well, when everybody else goes to do it all at the same time, that's when the whole thing begins to crumble.
Agreed. Hey, so website and tell us signing up and all that.
TFMetalsReport.com is the site. We've been at this now for, 6 or 7 years.
Long time.
And, it's crazy. I mean, we've seen prices go up, come back down, go up. Never been busier, never had more traffic, never had more subscribers than we have today. And I think it's a testament to the people that are on the site more so than what I do. I just kind of ride herd over the whole thing and post some analysis every now and then. The main value of the site, I think, still comes from everybody that uses it. And the willingness to share of everybody in the community and recognize we're all in this pot together, trying to survive as the global financial system is still roiling from where, what happened 8 years ago. We're all in this together trying to see our way through it. And I would just invite anybody to check it out, TFMetalsReport.com.
Hey, absolutely. We are all in it together. So send us an email, kl@kerrylutz.com, kl@kerrylutz.com. And we've got a Twitter feed @KerryLutz, and the Facebook page is Financial Survival Network. Hey, Greg, always great speaking with you, and we will definitely be touching base with you again soon. And I do have a feeling that 2017 is the start.
I'm with you on that one, my friend. I look forward to talking to you again.
FSN Radio. It's all about what's next. Go to FinancialSurvivalNetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Years ago, I got up and spoke about how it's basically alchemy. The central bankers of the world, especially here in the U.S., in trying to defend the dollar and gold standard all through the 50s and 60s, were losing physical gold hand over fist. And the U.S. took on that role in the 50s and lost about a third of their stockpile. So we shifted it to an international, a group of defenders, what we call the London Gold Pool. That worked for 7 or 8 years in the 1960s, and then it failed. But then the latest thing, which now has been in effect since the middle of the 70s, is this alchemy of paper or synthetic gold, allowing that to set price, because that's almost limitless how much synthetic.
FSN Radio. It's all about what's next. Go to FinancialSurvivalNetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is March 6th, 2017. Well, gold is down a bit. It's about 3 p.m. Eastern time. Oh, by the way, we start that idiotic ritual again, meaning rolling back the clocks, trying to make up for lost time, which it isn't really lost and we'll never make up for it anyway. That's this weekend on the 12th. So get ready to have your sleep cycles disrupted. But in any event, the gold cycle will down $7 and change the last time I looked, but we'll look again before, because the person you're about to hear from, things like that actually matter to him. And talking about Craig Hemke, aka Turd Ferguson, TFMetalsReport.com. And if you have any questions, comments, etc., send me an email, kl@kerrylutz.com, kl@kerrylutz.com. Craig, welcome back.
Hey, Kerry, good to visit with you again.
As always. So interesting things taking place in the world, throughout the world. I won't even get into the whole Trump thing, but looks like
synthetic gold has been created over the last 40 years. But it is the trading of those derivatives, that synthetic gold, that somehow sets price for the real thing. We'll see how much longer that can continue, but that is how it's done.
Yeah, talk about the tail wagging the dog, huh?
Right. Exactly.
Yeah, I'll never really understand what the heck this is all about. It just makes no sense to me whatsoever, but somehow it just keeps moving along.
Yeah, we hope that, the idea has been prevalent, in my mind, on my side, all through the gold community for years, that eventually there's going to be a failure, that you can only lever up
hit a little intermediate peak in precious metals prices, little pullback. The stocks basically broke down a couple weeks before the metals did, which is exactly what we've all come to expect.
Yeah, it's all part of what we've been dealing with for years. I call it the paper derivative pricing scheme, where price is discovered not through the trading of actual metal itself. Nobody ever actually says how much we give you, for my physical metal. It's always the paper derivatives that determine the price.
Right. Well, why would you look to the price of the metal to determine what the price of the metal should be? Why would anyone do that?
Exactly. I remember, Kerry, at the conference that you held in Las Vegas a couple